Welcome everybody to our Outlook 24 interview around the dynamic world of digital assets. And this time, basically in the context of institutional adoption. Today, we are very honored to host Matthew Sigel, who helms the digital assets research division at VanEck. And with a profound understanding of the digital asset ecosystem, Matthew is basically at the forefront, sharing research and analysis and insights that elucidate the transformative potential of this of the crypto domain. Some words on VanEck. It's known not just for its innovative ETFs, but also it's a player that's very forward-thinking in the digital asset space and currently manages billions in assets. It continually showcases its influence and trustworthiness in various markets. And today, basically, we aim to tap into Matthew's expertise as he hopefully provides us with a lens into the current and future trajectory of the crypto landscape. And therefore, Matthew, thank you for taking the time to be with us today.
Thanks for having me. Thanks for the kind introduction.
Yeah, you're welcome. So first off, I'd really like to state from the bottom of my heart that I absolutely celebrate VanEck's marketing campaign on Twitter. It's just awesome, and I think it really hits the mark of this very disruptive industry. Chapeau, and keep going. And second, I read a couple of days ago, congrats on the recent ETF Express Awards. It's a big thing, as I understood. Well deserved. So we have a lot of ground to cover today, and I suggest we start with a brief introduction of yourself and VanEck. And also, I'd be very keen to know why you dedicated yourself. I know you have a TradFi background. Why you dedicated yourself to this entirely new and interesting asset class. Go ahead.
Sure. So I started my career as a news reporter, a journalist at Bloomberg, CNBC. And what you find in journalism is that the logistics and the logistical effort involved in just getting images and audio on a TV screen or words on the print, so much time goes into that a lot of time focus is lost on the real work and the real truth. And we can see that today very clearly in the polarization of facts. But 15 years ago, I think I was relatively early to understand that the mainstream media was going through a huge period of disruption because of Web 2 companies like Google, and there was not much future there. So I always covered finance. I got jealous of all my sources who had bigger balance sheets than me, and networked my way into TradFi and ended up spending 4 years working for Cathie Wood, who now runs ARK Invest. This is during the AllianceBernstein days. So we were running global equity portfolio, very heavy in Web 2 platforms. We recognized that there would be natural monopolies that would form. And even though this was pre-Bitcoin days, we were asking ourselves, what is going to disrupt these supernormal margins that Google and its peers are likely to generate? It's, the disruption can come from regulation or it can come from innovation. And being a relatively free market capitalist, I hoped it would come from innovation. So when Bitcoin started to take off, I just identified that as a killer app that would leverage the new kind of liberalization of cryptography that had emerged when Bill Clinton allowed for cryptographic exports in the early part of this century, which kind of turbocharged the growth of Google and Web 2. So, the irony is that, and I'll bring current events into this a little bit as a Jewish person, Bitcoin kind of always appealed for me as something that would be easier to hide in my butt than diamonds. And maybe I'd be tortured in creative ways for my passphrase. And given the performance of the asset right now, it seems like others may be thinking along the same route. So that's a bit of an irony. After working for Cathie, I had 10 years in investment banking, research, and sales, equities. And it's during that period that I began to invest pretty heavily in Bitcoin and other digital assets. Meanwhile, VanEck, as an $80 billion money manager with large exposure to gold and gold mining stocks, We are a macro thematic shop, and the CEO, Jan VanEck, is someone who embraces the innovator's dilemma, and we didn't want to let Bitcoin disrupt our gold holdings without getting involved in that ecosystem. So VanEck's, unable to get the spot Bitcoin ETF to market in 2017 when we first filed, began investing in Bitcoin and investing in venture off the firm's balance sheet in order to get smarter and build a network. And then I joined in 2021 to accelerate the product offering. So we now have almost 20 products across digital assets. Many of them are passive ETN products in Europe. And then we've got a number of private funds here in the US. So it totals to about 500 million in digital assets compared to our 80 billion in TradFi. And we think that ratio is likely to grow over time.
Yeah, okay. Hey, thanks. Very interesting background. With your private keys, I like just a couple of weeks back, I thought about the fact that it's very hard to get to your assets if, say, you just have your private key in your head memorized, right? So there's no way to get access to them. Kind of, it's great. I think I want to dive into the subject spot ETFs first. So as we know, a lot of momentum currently centers around the potential US spot ETF, and VanEck is also like part of that race, kind of. And January is knocking on the door where the final deadline sits for some of the applications. And as you said, very impressive then that VanEck was actually one of the earliest applicants, like dating back to 2017 or 18. 17, right? So I'd like to know from you, what's your outlook on when do we get green light, and how is VanEck currently preparing for that scenario?
So there's a few limitations as to what I can speak to about the ETF because our filing is live with the SEC, but the deadlines for these products are basically all in the first couple weeks of January. So unless something changes in the body language of the SEC chair, we would expect all products to come to market generally at the same time by January 10th. Mm-hmm. Could be earlier, really depends kind of how quickly the SEC can circulate the docs around their various departments who all have to chime in.
I mean, the markets like kind of price in or react to what you said already. Like I just read that we had a great spike in inflows to various funds. Let's cover a little bit the potential implications, because as we know, like a spot ETF currently is considered to bring way more demand, right? And the halving is also like we have a halving event in April. So given the law of supply demand curves, right? So we should get more demand while having less supply. And therefore, we should see a higher equilibrium price, right? And also, there are some pretty cool statistics on long-term holder supply versus supply that moved in less than 24 hours. That is kind of diverging as well. So we see signs of declining on-chain liquidity. And just recently, we also had a report with Coinmetrics on free float supply. So what I'm trying to say is like this kind of price inelastic supply of Bitcoin and all the upcoming catalysts should lead to a fairly high impact of this ETF. And there's also a lot of numbers from Galaxy Digital, for example, on how much value will flow into these ETFs. What's your outlook on that? And I would also like to know from you, why is that US spot ETF different? Or why will it have an impact when the Canadian one didn't have a lot of impact, right? What are the differences here? Because we have spot ETFs already.
Yeah, I think one interesting stat over the last month is there are about 30 Bitcoin ETFs that are already on the market, and those are a mix of spot products in Canada and Europe and the futures-based products, including ours, that trade here in the US. In the last month, those products have seen, just the Bitcoin ETNs, have seen a combined inflow of $400 million US. The total year-to-date number is $600 million year to date. So 2/3 of the inflows into all these products came in the last 4 weeks, and that coincided with what Bitcoin's up 26% in October. So I think that's an indication of how much the price can move on what feels like relatively modest flows when those flows are one way. And this will be, the spot ETF is basically going to be, you're going to be mainlining a Bitcoin-only exchange directly into the veins of every brokerage account holder in the US, including the registered investment advisors that have not been able to buy these futures-based products. So the reason why it matters is because the size of the US institutional capital markets and asset management industry is orders of magnitude larger than it is in Canada or Europe. And you have a much more kind of free market DNA among American investors. So the SEC's objection was around issues of custody and market manipulation. As Coinbase has gained market share throughout the year, and the SEC looks set to bless these products, those fears have faded. And we were debating it on the morning call this morning. What would be a successful outcome? What would be an unsuccessful outcome? Somewhere in the $100 million plus range on day one and $1 billion plus at the end of month one, we think are around the base case for what these products could attract.
Okay. Yeah, I mean, that's already like fairly substantial numbers. And I think I fully agree. And I also think like we see that also in the regulatory landscape, like the eyes are always aimed for the US as it is kind of the role model, and everybody like tries to stick to what the US does. And I guess a spot ETF will like bring a huge bump in legitimacy, right, to that asset class. So from like not only institutional investors face that problem, but also retail investors. And the problem I'm talking about is how do we know what is the fair value of Bitcoin or ETH when I buy it, right? So I want to bridge over to valuation models, where I think VanEck is one of the kind of the pioneers, and in my opinion, like you have the most sound valuation models for both Bitcoin and ETH. And I would like to start at the surface a little bit, because let's start with traditional finance. It's a common thing to have valuation models, and there are various tools on how to value different assets such as equities or commodities. But since digital assets are a fairly new asset class, there are still plenty of entities like VanEck trying to come up with proper valuation models. Therefore, let's dive into these, and why are they important, and what kind of traditional tools can we currently apply to the digital asset space. It would be cool if you could give us an overview of the current valuation methods that are available in traditional finance, and how we could potentially apply them to the digital asset space. And afterwards, we will like go into more details on Bitcoin and so forth.
Sure. I think you identify what is a pretty large obstacle for institutional investors to buy tokens directly, and that's a lack of a cohesive and kind of commonly agreed upon valuation model. Many of the most sophisticated institutional investors want to have risk parameters around the assets that they're buying. They want to be able to identify what is fair value, what is the replacement cost, what is the possible upside potential. And in equities, you basically do that by trying to predict what the earnings of a company will be, say 5 years out. Try to figure out what valuation the market may pay for those earnings. So that's price divided by earnings, PE ratio, and then discount that back to today. And for stocks, earnings consist of a numerator, the income, and then the denominator, which is the shares outstanding, right? And in TradFi, generally the shares outstanding portion is relatively predictable, and it's governed by regulation and self-regulation around new share issuance and the disclosure that has to come with granting new shares. In crypto, there's just a lot more known unknowns. You're basically holding call options on this alternative financial future in which open source blockchains intermediate a meaningful percentage of the world's financial flows. But how many tokens there will be outstanding, how that token will capture value from all the value that's going across its network. The tokens oftentimes blend elements of commodities, currencies, equity, fixed income, all into one asset. So it's a very bespoke process. And I'd say that that's one of the reasons why we have a lot more uncertainty in our valuation models for crypto than we do for equities. We recently put out a piece on Solana. The price target ranged from $10 to $3,000 with a base case of 300. And I understand the kind of pushback and laughter maybe about how wide that range is. The lower bound could be zero. We did not say that, but these call options are just incredibly volatile. And in most cases, the cash flow, the stream of earnings that we want to project and then discount back to today haven't materialized, right? We're buying liquid venture, which in a lot of cases does not even have revenues or earnings. So we have to kind of center ourselves around three major pillars. What's going to be the penetration rate of these open source blockchains? How much market share are they going to take, and in what categories? We kind of divide the world into three categories. So the one pillar is penetration. The second is market share, like how much of that open source blockchain value can blockchain A capture. And then the third pillar is the monetization. What's their take rate going to be of all the value that flows across the blockchain? And from there, we can arrive at a cash flow estimate, from which we deduct expenses, which often include validator expenses and taxes, and then we DCF that back to today. So that's the overarching way that we approach it.
Okay, I mean, I saw the Solana report, and I also figured the range is quite a broad range. But honestly, it's a first and very proper attempt in order to get to some numbers at least, where you have a rather high degree of confidence, right? I felt that the discounted cash flow model is one of the most powerful tools in order to value certain digital assets. However, that does not apply to Bitcoin, because Bitcoin is more perceived as a commodity in a store of value, like a digital gold alternative. However, I mean, there are all of these tables in the different reports. Bitcoin actually substantially wins against gold and fiat currencies when it comes to monetary trades, right? So just to name a few, we can talk about scarcity, durability, portability, divisibility, or scalability, for example. And in all of these trades, Bitcoin seems to be like the winner against both fiat and gold. So I know you also digged into Bitcoin valuation models. Maybe share with us how did you do that, and what's basically this monetary premium approach? How is that looking like, and how did you come up with like cash flow multiples, if there is such a thing in Bitcoin?
Yeah, our Bitcoin valuation is different from others, right? And to your point, Bitcoin's not a cash flowing asset except to the miners, so it's impossible to do a DCF for now. Like, we'll see, and this is hotly debated internally, that Ethereum's roadmap, which includes making Ethereum more like just a settlement layer, and transactions and data availability happening on other chains, that actually makes Ethereum and Bitcoin maybe more similar than they have been in some number of years. So our BTC price target is 275,000, and it doesn't incorporate any of the potential that Bitcoin becomes a settlement layer for other smart contract layer 2s like Stacks or Lightning Network. It really just looks at what's the stock of all the gold that is above ground and held for investment purposes. And let's assume that Bitcoin reaches half the market share of gold as a ratio of all the money outstanding in the world. And that's how we get to 275K on BTC. If there becomes like a functioning stablecoin market on a Bitcoin L2 or a flourishing NFT market, that would provide upside to our target price. But we're basically looking at the polling of young people that show that they perceive Bitcoin to be digital gold.
Yeah.
And then given our significant gold holdings, we have a decent read on the supply-demand dynamics in the gold market.
So you derive it from the gold market, basically. Yeah. The aspect you just mentioned with demographics, I think it will play a very crucial role. If you imagine like all the wealth at some point in 10 to 20 years is flowing to all of these young people who like are way more familiar with digital assets than they are with whatever real estate, for example. What I'm trying to say is, I guess, like that demographic aspect or wealth transformation will be useful in my opinion.
And I do think this is a retail-driven asset class. So when I first got into Bitcoin, like 2016, 2017, and there were taxi drivers pitching it to me. I remember traveling on business and stuff. and I got to my meeting with institutional investors, and they're like, "Oh, that's a top signal. Even your taxi driver was talking about it." I'm like, "No, you don't get it. This is a retail-driven asset. It is meant to disrupt your business. The taxi driver talking about it is bullish, not bearish." Now, there may be a point when that turns, and I do think that we're going to need institutional adoption, and we can get into like how we define that to power the next leg of this bull market.
Did we ever have such an asset, a retail-driven asset? I like that rationally. I never heard it, to be honest.
I mean, lots of collectibles are like that. If you look at how people in China, for example, who want to get their money offshore, like a lot of times they're using Rolex watches. That's a type of asset class that individuals use to transport and transact. There's less institutional participation. So, it's collectible commodities with unique characteristics that preserve purchasing power. And Bitcoin now, it's 15 years of franchise value. So it's a brand now. Stanley Druckenmiller was just talking about that last week. So I think that's what appeals to the young people. And the other thing is Bitcoin does have a use, which is that it absorbs stranded energy. So the oil and gas and coal companies, especially outside of the US, that are facing bigger barriers to get their product to market, either because of carbon intensity targets or US sanctions, Bitcoin provides an incredible sink to monetize that stranded energy and then move it anywhere in the world. I noticed that Argentina's largest private oil and gas company that accounts for 15% of domestic Argentinian production just announced that they will be mining Bitcoin with the excess gas that is created in the flaring process. So I think that'll continue as well.
Yeah, cool. Also, I like to recycle back a little bit to what you said with that Ethereum might be on the path to a valuation model that might be more keen to the Bitcoin one. But on the other hand, like Bitcoin might also come to the Ethereum kind of cash flow side, right? Now that we see like way more developments on L2s, like there might be at some point, we saw with the BitVM, right? And maybe I know like Eric Wall, for example, they are trying to build a CK rollup for Bitcoin. Yeah, of course, it would be awesome to make it happen without the change in opcodes, but yeah, maybe it's necessary at some point. But then it will be a great thing because we see it in Ethereum that the fee follow the functionality kind of. And currently, like Bitcoin does not offer too much functionality, but at some point it might, and then we also will have some cash flow towards or more cash flow. Yeah, and let's see how that develops. Who knows? Everything can happen in crypto, right? Now maybe let's shift over to Ethereum because as we mentioned already, very different aspects are at play for Ethereum. For instance, we have reward emissions in the form of staking rewards, but also we have a dynamic that is very akin to kind of buybacks in the stock markets, which it's burning mechanism. And both play a vital role in your valuation models, and fairly so. And so do also transaction fees and MEV, like basically every value that can accrue towards the base layer. So if you don't mind, please guide us through your Ethereum analysis framework, and also don't hesitate to outline your bull and bear cases for ETH based on your cash flow multiples.
Yeah, I think one way that might be helpful is just comparing and contrasting the Solana price target to the Ethereum price target.
Mm-hmm.
So our base case for Solana implies about a 10x upside. And that happens with Solana achieving just a 30% market share in terms of the value being intermediated among all open source blockchains. For ETH, we get 5x upside, and that's assuming that ETH captures double the market share, more than double the market share of Solana. So we'd need 70% market share for that 5x. So you can just with that kind of simple math, you can see that in a vacuum, risk reward for Solana appears to be a lot better than Ethereum. There's very little in the price in terms of what the market is expecting on their terminal market share. Now, you also have to account for the volatility of the token, some of the unique supply demands of the token, the level of uncertainty around the future roadmap, the lack of any meaningful TVL on Solana. But like in a vacuum, you'd have a higher Solana weighting than you would Ethereum in our kind of fundamental model because of the upside that can be generated with half the market share. One of the key variables, I mentioned those three pillars that we get into: penetration, market share, and monetization. In our Solana model, we're assuming that the token captures value at 1/5 the level of Ethereum. So the blended Ethereum token take rate comes out to about 2% in our model when you combine the finance and market, kind of metaverse and social and gaming, and then infrastructure. For Solana, we're assuming about 60 bips blended. So much lower take rate. The network is engineered from a perspective of abundance, whereas Ethereum appears to be engineered from a perspective of scarcity by pushing all those transactions to L2s.
That's highly interesting, Matthew. Also, like I just checked, for example, in the last couple of weeks, ETH like snapped back into a slightly inflationary environment. And
there's nothing going on chain, right? That's one problem with this rally this month, is that there's very little happening on chain. Like the flows are coming from these ETNs, and we can see the ETH BTC ratio breaking down. It looks quite similar to me as it did in late 2019 when BTC had bottomed and was kind of in a choppy but upward range, and the ETH had not. And the market didn't sound all clear that we're into this new bull market until the BTC halving, and then ETH dominance rose along with the entire market cap. So that's kind of my framework, is that we're in that like late 2019 parallel. Same thing's happening in Bitcoin miners. They're lagging the Bitcoin price pretty dramatically here, which also occurred pre-halving in 2020. So for ETH, I just think we need to see more on-chain activity. That's what drives gas fees. That's what drives monetization of the token, and BTC, like the use case is hodling.
I agree. From the Sigel perspective, it's very similar. We are in a slightly inflationary environment. Maybe it's based on the fact that there's less on-chain activity, but at the same time, if you check how much transactions are happening on L2s, like we are now at a scaling factor of 4.8, is there maybe the case that kind of block stays becomes abundant as well on Ethereum via L2s, and we have a kind of same scenario that we see with Solana? Is that a possibility? So that there is activity, but it doesn't happen on the base layer anymore. it rather happens.
Yeah, no, I think that's the
outsourcer.
thesis. But even the L2 transactions started tailing off, right? I think it was in August, which really corresponded with the new leg lower that we've seen in the ETH BTC ratio.
Yeah, true. They kind of peaked. And I guess a lot of activity is also probably not organic because there's still a good amount of airdrop farmers out there trying to get some tokens from airdrops.
Yeah, you can tell from our approach that we're trying to make money by taking a slightly longer term view than the kind of high frequency folks. So the volatility of market share within the L2s is quite high and unpredictable to justify like large positions in those types of tokens. So from my perspective, it's more of a wait and see on those.
Yeah, fair. I mean, the layer 2 narrative is still very alive, kind of. And what I find very interesting is how much value in the future might accrue to these layer 2 rollups, because there are several dashboards where you can see that it's substantial already what they take as a delta between transaction fees, what they catch and what they have to pay to the base layer, but also the MEV that now accrues to layer 2s. So yeah, definitely something to watch, but there are some kind of established players, in my opinion, already, such as Arbitrum. They are like since the very beginning, or Arbitrum and Optimism, basically the big ones that launch already, that are like made more progress on the decentralization side and so forth. So yeah, agreed. Very interesting, but also very volatile space, and there's no clear winner yet. I'd like to refer back again to valuation models especially for Ethereum or for that cash flow asset, because when I thought about it, I stumbled upon a fact that I'd like to know from you. How do we make sure that we consider that difference compared to stocks? And what I'm talking about is that neither dividends in the most common case nor buybacks in stock markets change the total supply, right? There's no burning of supply, and if there's dividend, it's usually paid in fiat, and there's no supply basically issued inflationary. But for Ethereum, both dynamics like burning and staking rewards, like reward emissions, basically impact the total and also the free float supply. And another important difference, in my opinion, is that digital assets and stocks have digital assets, have way less overhead and substantially higher margins. And I wonder, how did you adjust these two facts in your valuation models, or did you look at it at all?
Well, I would disagree a little bit with the premise that equities who buy back their shares don't occasionally see declining share count. They do. And that declining share count can make the earnings per share look a lot better. And you can see that with like many equities that ended up having like negative equity. I think it was like McDonald's, or like look at Johnson & Johnson right now. So it is possible to buy back shares, decrease your share count, and make your stock go up because of that. In the case of the crypto assets, determining that terminal supply is one of the biggest unknowns that we have. Like when I looked at every other Ethereum model, they all essentially use the price of Ethereum in order to predict the price of Ethereum, which doesn't make any sense to me. You have to start with some top-down beliefs about what this asset class, what the penetration levels can be, and then what the take rate for the network can be, benchmarking against existing networks with similar functionality. And the whole use case here, I think, is that this is a deflationary asset class that brings automation to existing workflows and like should enable cost savings and consumer welfare because of that. So that's kind of how we think about it. Like in the case of ETH, in our base case, by 2030, we see 5% of all finance, banking, and payments revenues going through open source blockchains. We see 10% of kind of infrastructure, meaning like decentralized compute, storage, networking, wireless, etc. And then we have this third category, metaverse, social, and gaming, where the penetration rate is 20%, so much higher because we think that crypto assets can enable new markets in those emerging kind of consumer tech areas. And then we look at the value capture. How much can the Ethereum token capture as a percentage of all that value, benchmarking against competition in the Web 2 or TradFi world? And because finance is such a competitive and mature market, we give ETH just like a 3% take rate. For infrastructure, we give it a 5% take rate, looking at like kind of what AWS margins are and others. And then for metaverse, social, and gaming, our take rate is much higher, as high as 10%. So, and then like when we're monitoring this, we're going into the subcategories. Who's consuming the gas? What category do we put them into? How fast are they growing? Is that application likely to sustain momentum, or is it just being like goosed by airdrop incentives? So that's kind of how we think about it, is in an end market by end market basis. And then we had to make some considerable assumptions to figure out what percent of the outstanding ETH would be burned and how many transactions might occur. But like the number of transactions is really not that relevant. They're selling block space. So it's about how much data, what's the demand for data across these blockchains, and which chain is going to be most efficient and able to sell that space at the most predictable and lowest prices.
Thanks for the insights. I thought that buybacks are like usually end up in the treasury and therefore not really removed from the total supply. While
usually that is the case. That is the case, but it doesn't have to be. And there's considerable like regulations around how transparent companies must be around their share count.
Okay.
Yeah, but like I was looking at the Bitcoin miners just the other day, and the top 5 miners have grown their share count by an average of like 400 to 500% in the last 3 years. So we gotta keep those companies' feet to the fire as well, right?
Yeah, true. Okay. So to consolidate the last couple of minutes, like basically to sum it up, ETH can more or less be perceived or valued akin to kind of a growth, high beta stock or equity kind of cash flow and dividend paying asset, while the characteristics of Bitcoin lead to a valuation model that is more akin to a commodity, which is mostly driven by a monetary premium. I'd like to know or to have your take on what of these asset classes is usually performing better when you have very tight monetary conditions and an inflationary environment? Is it cash flow assets, or is it a store of value kind of commodity? Why is it both?
Yeah, that's a good question. I mean, in the real world, when there's a big risk-off event, then profitability, cash flow, strong balance sheet tends to outperform. In crypto, the correlations are more volatile, and like just when you think you're in the safe asset, aka like ETH versus alts, let's say in May or June of 2022, the bear market is underway. Luna has collapsed. The alts are acting terribly. Everyone's crowded into ETH, and then boom, there's a deleveraging event, and ETH went from being the lowest vol crypto asset to the highest vol crypto asset. So, like, I have some biases around, which of the digital assets should be the highest vol and the lowest vol, and like Bitcoin should probably be the lowest vol in my opinion. But 2 weeks ago, we got to a point where Binance, BNB, and Tron TRX were at lower vol than Bitcoin. That didn't make any sense to me. That's a signal you want to buy BTC and ETH and sell TRX and BNB. Like that's played out here in the last couple of weeks. So it's just so much more of a changing and dynamic environment in digital assets that I hesitate to put like huge money behind these comments, but that's my sense.
You have to be on your toes continuously in these markets. Yeah. Let's head over a little bit to why we need crypto in a portfolio and how that will play out in the upcoming years. So, for example, Larry Fink, right, just recently shifted his crypto emphasis rather significantly. He now considers it to be a kind of flight to quality and safety asset. And also, like, neutrally, it's one of the best performing assets year to date, even on a risk adjusted basis, right? And also, I read some tweets that stated that even some of the financial advisors shifted from a potential 1% allocation to now considering even a 5% exposure to crypto being perceived as good or perceived as beneficial. I would like to know, like, why will digital assets, maybe based on these facts, become an integral part of portfolios, maybe even in the not too distant future? And is crypto like really that ultimate hedge like we see right now in a portfolio against sticky inflation and monetary debasement and extreme fiscal policies? What's your take on that?
Well, at VanEck, we are fundamentally macro thematic investors. That's the DNA of the firm. We meet twice a week as a firm. All the active management professionals and all asset classes are present. Emerging markets equity, emerging markets debt, multi-asset portfolios, natural resources, digital assets. And the one theme that continued to arise over the last several years is just the vast amounts of debt in the world and the declining credibility of those who are issuing it, i.e. G7 governments plagued by incredible amounts of polarization and disagreement about basic facts. And the basic fact around what the US debt levels are going to look like, the implications of that have not been properly digested by investors. And we see a possible future in which the interest expense alone on US debt could be 60% of all tax revenue. And that's just at 6% interest rates, right? If we got up to 8-9%, you could be looking at a scenario in which interest expense on US debt is 100% of US tax revenues. How can you pay for necessary items on that point? What is left on the policy plate that the Fed has not already tried? There's wealth tax, maybe. There's a default. There is explicit printing and paying, which looks like is what we're going to do in this next kind of Israel-Ukraine package. And you just wonder what young people are going to think as they come of age and realize that they're paying more interest on debt than they're getting back. And Bitcoin in particular acts as a protest vote from U.S. government trading counterparties who no longer want to fund some of what the U.S. tax revenues are going to, namely sanctions, war, super woke policy at the social level. And they're looking for some type of neutral monetary system that is not subject to the whims of these unaccountable Fed bureaucrats who keep getting it wrong. So, I was in a Twitter debate with like a pro-Palestinian person just a couple hours ago. They're a Bitcoiner. I'm a Bitcoiner. We disagree pretty vehemently on what the facts are on the ground in the Middle East, and we agree that every 10 minutes, Bitcoin's going to create a block that contains a version of the truth that both sides agree on. And for the countries that are on the fringes of the world's financial system, like El Salvador being a good case in point, and hopefully Argentina in a couple of weeks, they will slowly adopt Bitcoin either for their central bank reserves or as legal tender over the next couple decades, just as a safety valve that lets the entropy from this polarization out into something which everyone can agree on. So that's where kind of my strongest conviction is. And then the past cycles show that when Bitcoin rallies, folks take their profits and speculate on kind of higher risk, newer assets, right? And in past cycles, that was Ethereum and the long tail of alt L1s. I think there's a lot of policy work that needs to get sorted out in the US before those tokens are like bought and put on company balance sheets or country balance sheets. I think that day is much closer for Bitcoin. And then we'll see what that rally will unlock for the rest of the ecosystem. But in our terminal DCFs for Ethereum, remember, we've got this 5% penetration level for finance, banking, and payment revenues. It's still a very, very modest target that gives us 5x upside for ETH, 10x upside for Solana and BTC.
Yeah, if you have that context, that 5x actually seems like pretty conservative. And I fully agree. If you look at the macro landscape currently, right, the S&P is kind of in a correction territory. Just recently, it dropped like 10% from its top, I think. Then we face an ever-increasing monetary debasement. The Fed is trying to curb inflation, but GDP is still rising above expectations, right? As you say, there might be that spiral soon. Just yesterday, I think the Treasury announced that it puts another 1.6 trillion on top of their debt pillow. That, like, if you think about it, it's more than double the market cap of Bitcoin that it just add in the next 6 months. Like, Bitcoin seems tiny if you look at these numbers. And then, for example, there's this great Kobisi letter or something like that, I think, that I follow. They just came out with the news that the house prices in the US are incredibly unaffordable. You need 100K in annual income currently, while the median household income is only 68. And 3 years ago, it was 60. So these numbers are just crazy. And yeah. And also the yield curve is uninverting. I feel it's very hard to navigate that space right now. And if there's one asset class that benefits from all of that, it has to be crypto. Arthur Hayes in one of his recent reports said soon they throw on the money printer again, and we will have a big party. But afterwards, there's also a big hangover coming.
And meanwhile, Bitcoin makes higher highs and higher lows throughout each cycle. Best performing asset class, 3, 5, 10 years. I don't think it's going to be too hard to get some of these institutional investors to put 50 bips or 1% into a spot Bitcoin ETF. Remain hopeful that that's one of the major catalysts of next year's bull run.
Yeah, very cool. I feel stars are aligning right now, kind of. And there's another, in my opinion, might be also one of the major catalysts. It's tokenization. I know it's a flavor of the last quarter, kind of. So real world assets are also getting traction in the midst of elevated risk-free rate. The on-chain citizens want to have access on-chain without moving off-chain. So on-chain treasuries are booming right now. And then there's like tightened credit conditions, right, from banks. They don't want to loan out money anymore. So private credit markets might be the next area that we'll see big momentum. And real world assets, to me, like what do they allow us? We can build traditional portfolios on chain at some point. We have even more diversification potential. We bring liquidity to illiquid off-chain assets and so forth. So there's a lot of stuff to be excited about. And I'd like to know from you, how do you see the real world asset narrative to play out in the coming months and years? Will it also be just another kind of bullish catalyst?
So we've done a lot of work on the real world assets, both from an issuer perspective as well as an investor perspective. And I have to say that the conclusion is not too bullish. The real world assets that are going on chain, especially these T-bills products, which by the way peaked a couple weeks ago, and now the AUM has been declining as folks maybe take assets out of that and try to chase the BTC bull run. But most of these assets are not permissionless. They must be minted to whitelisted wallets. They cannot be pledged in DeFi unless that DeFi exchange itself is essentially a whitelisted entity. They offer lower yields than you can get in T-bills directly with less security because of the smart contract risk and the lack of liquidity. So I appreciate the infrastructure that's being built, and in our venture portfolios, we are invested in some of these infrastructure builders.
Mm-hmm.
But as an $80 billion TradFi player, we have no interest in putting a portion of those assets on chain because lower liquidity, more risk. And then as an issuer, we're struggling to see the economics. And especially with Mika, even bringing a simple commodity gold token to market requires treating it like a stable coin. There's all types of capital requirements that Mika demands, and it's very tough to make the economics work unless you are already at scale. So Mika seems to be more about regulatory capture and entrenching winners than it does about really unlocking innovation in this space. And it feels to me like these T-bills products are a place for sophisticated digital assets investors to capture yield when they are bearish. And maybe that becomes a bigger story like in 3 or 4 years when hopefully Bitcoin's made an all-time high and much of TradFi is now involved and they want to take risk off the table. But if you're looking at this, hopefully what's the beginning of this bull run and a much better setup for 2024 with the halving and the election and the ETFs, like why do you want to dither around in these real world assets? I'm just not seeing the use case.
Okay, makes sense. Very interesting. And also a very nice alternative view on all of these very bullish views, kind of.
Yeah, I mean, look at Makers like underperforming pretty dramatically here in the last 1 month. That was like the best proxy for real world assets. Appreciate very much the revenue that they're able to derive from that, but in a period when it's risk on, that token's down.
Yeah. What do you think about the current risk-free rate, which, considering the debt and the deficits and the monetary debasement, making it appear not so risk-free anymore, to me at least. Do you think there's a future where the ETH staking rewards become the risk-free rate? Is that a possibility?
I mean, it will for a very small subset of digitally native corporations, right? But even in our bull case, that's less than kind of 10% of financial activity. So I like to think about which countries are most likely to adopt digital assets as a part of their policy. And I think about, for Bitcoin, that'll be countries that are like rich in energy. And for Ethereum, it would be, countries that are rich in human capital, that have programming talent to actually build a storefront on Ethereum, to build a business on Ethereum. It has less to do with your energy and more to do with the human capital in your country.
Yeah, I think we are not too far away from finally getting to that like breakthrough application stage where maybe the infrastructure layer is not the focus anymore, but adoption is really driven by by a major application. I feel that should happen within the next year. Let's see. There were some signs already that like VanEck, and there are still a lot of developers active. I'm very keen to see what happens in the next year. Hey Matthew, let's close the interview here. It's been an absolute pleasure to talk to you and get experience and knowledge from you. Your insights into this very dynamic, volatile world of digital assets were invaluable for us and very enlightening. And on behalf of Bitcoin Swiss and our audience, thank you so much for sharing time with us and the knowledge with us.
Great spending time with you all. Thank you, Don.